When London learned how to control capital, money did not always move at the speed of thought. Once it waited, it hesitated, it obeyed borders. But somewhere in London, that changed forever. To understand how London learned to control capital, we need to return to a time when money was stubbornly physical. Gold had weight, paper had limits, wealth moved only as fast as ships, horses, and trust allowed. Finance was local, fragile, and deeply human. And yet, the pressure to move money faster never disappeared. Empires expanded, trade routes stretched, wars demanded funding, merchants demanded certainty. The old system could not keep up. London did not set out to dominate global finance. It simply sat at the intersection of trade, power, and necessity. The city absorbed ideas from Amsterdam, Genoa, and Venice. But instead of copying them, London refined them. It asked a different question. What if money did not need to move physically at all? What if trust could travel instead? The answer emerged slowly, through coffee houses filled with whispered deals and handwritten ledgers. Merchants began settling obligations without coins changing hands. Debts were offset. Promises replaced metal. The first realization was subtle but profound. Control over capital did not require owning the money. It required controlling the system that recorded it. This shift mattered because it solved a growing problem. Trade was exploding, but liquidity was scarce. Wars drained treasuries faster than gold could arrive. The old rules created bottlenecks. London's response was not louder authority, but quieter infrastructure. Institutions formed to standardize trust. Rules emerged to make promises predictable. Risk began to feel manageable. At first, this seemed harmless, even elegant, a way to reduce friction and increase efficiency. But beneath the surface, something deeper was forming. Capital was being separated from place. Value was becoming abstract. And London was learning how to sit at the center of that abstraction. This was not a single invention or a dramatic announcement. It was a series of small decisions, repeated daily, that slowly rewired how money behaved. Each ledger entry reduced the need for physical settlement. Each standardized contract weakened borders. Each new institution concentrated influence. By the time anyone noticed the scale of the transformation, it was already embedded. London was no longer just a city where money passed through. It was becoming the city where money learned how to move. And this was only the beginning. The next stage of the story is where London's control became invisible. Because once money becomes an idea, it can be engineered. The city did not conquer the world with armies. It conquered it with systems. Quiet agreements, standardized language, rules that looked boring on paper, but shaped everything in reality. And the moment London realized this, it stopped trying to chase capital. It started building gravity. The earliest versions were imperfect, almost improvised. A merchant would owe another merchant who owed a third, who owed a fourth, instead of everyone paying everyone. London began to simplify the chaos. It created routines, settlements, a place where obligations could be cleared without panic. And once clearing becomes normal, confidence grows. When confidence grows, money flows faster. When money flows faster, more people want to plug into the same network. That is how power forms in finance, not through ownership, but through dependency. London's advantage was not just location, it was reputation. A legal system that investors believed in, contracts that could be enforced, a culture that treated debt like a tool instead of a shame. And behind the scenes, a growing belief that if you could quantify risk, you could sell it, trade it, even profit from it. The more London refines machinery, the more it attracted capital from everywhere else. Not because London was safer, because London was useful. It offered something the world desperately needed, a place where money could pause, reset, and move again with new purpose. But then the next innovation arrived, and it changed the emotional temperature of finance. Credit expanded. Suddenly, the economy did not have to wait for gold. It did not have to wait for profits. It did not even have to wait for reality. It could borrow from the future. It could pull tomorrow's value into today's decisions. London learned to do this with precision, and the world watched in awe. At first, credit felt like liberation. A merchant could grow faster. A company could build sooner. A government could fight now and pay later. Everyone became more ambitious, more daring, more dependent on the promise that the future would always be bigger than the past. But here's what most people missed. Credit is not just money, it is belief. And belief can be manipulated. London's institutions grew more sophisticated, and with sophistication came distance. The people moving the numbers were no longer the same people who felt the consequences. Money became cleaner, faster, more abstract. It stopped smelling like smoke and salt and ships. It started smelling like ink, paper, and polished wood. And in that polished world, the system began to change its purpose. It was no longer only about moving capital. It was about controlling who could access it. Because once capital is flowing through your channels, you get to decide what counts as legitimate, which deals get funded, which companies get oxygen, which nations get relief, and which ones are left to suffocate. This is where the first tension quietly appears. London's machine made the world richer, but it also made the world dependent. And dependency always comes with a price. At some point, London stopped being a marketplace. It became a switchboard, a place where capital could be routed, delayed, redirected, or accelerated. And the people who controlled the switches rarely needed to speak loudly. They only needed to understand the flow. Because in finance, control is not about force. It is about timing. The city learned to master that timing through layers of institutions that looked separate but moved like one organism. Banks, brokers, clearinghouses, legal firms, insurance markets. Each part seemed ordinary on its own. Together, they formed something powerful, a machine that could absorb global demand, compress it into numbers, and release it back into the world as influence. And this is where the conflict begins to sharpen, because the same system that makes money move smoothly can also make money disappear. Not vanish into thin air, but vanish from accountability. When capital becomes abstract, it becomes portable. When it becomes portable, it becomes evasive. It can slip between jurisdictions. It can hide behind structures. It can be renamed, repackaged, and resold until it no longer resembles the original risk. And London, with its deep expertise and global reach, became the perfect place for that transformation. The city didn't just move money. It transformed money into instruments. A loan could become a security. A future payment could become a tradable product. A risk could become an asset. And once risk becomes an asset, something strange happens. The incentives shift. People stop asking, is this safe? And start asking, can this be priced? Because if it can be priced, it can be sold. And if it can be sold, it can be repeated. London's talent was not greed. Greed exists everywhere. London's talent was architecture. The ability to build financial structures so complex that even intelligent people could mistake them for stability. The contracts looked official. The paperwork looked complete. The numbers looked precise. And precision creates trust. But precision can also create illusion. The deeper the system grew, the more it rewarded those who understood it. Not the workers who produced value, but the operators who could interpret the language of capital. The people who knew how to move money through channels, how to extract fees, how to shift exposure, how to profit from volatility without ever touching the real world. And the gap widened between those who lived inside the machine and those who lived beneath it. For the average person, the financial system still felt like a background force, a distant structure that determined interest rates, mortgages, jobs, and prices. But for the city, it was a living map of opportunity, a landscape where wealth could be designed. And then came the moment when the world began to realize the danger, not in one dramatic collapse, not in one headline, but in the slow accumulation of fragility, more leverage, more complexity, more confidence built on assumptions, more belief that the system could never fail because it had never failed before. London's money machine had become too important to question, too central to challenge, too embedded to replace. And that's when the paradox appears. The stronger the machine becomes, the more catastrophic its failure would be. Because if London is a switchboard, then every market, every bank, every pension fund, every government budget is connected to its rhythm. The world doesn't just trade through London, it synchronizes through London. And when a system becomes synchronized, a small shock can become a global tremor. But nobody wants to admit that, because admitting it would mean confronting the truth that the machine was never built to protect everyone. It was built to keep moving. And then it becomes clear. London didn't just learn how to control capital. It learned how to control the conditions around capital. Because when money is no longer a thing but flow, the real power is not in having it. The power is in shaping where it goes, when it moves, and who is allowed to touch it. That is what the city mastered over centuries. Not through a single mastermind plan, but through a steady evolution of rules, habits, and quiet authority. The climax of this story isn't a crash or a scandal. It's a realization. The modern world runs on financial plumbing most people never see. The salaries we earn, the loans we take, the prices we pay, the pensions we depend on. All of it is influenced by networks that settle obligations in the background, every hour, every night, every day. And London became one of the places where those networks learned to behave like a machine. Sharp, efficient, relentless. But efficiency has a shadow, because the same tools that create stability can also create dependency. The same infrastructure that lowers friction can also concentrate power. And the same systems that move capital quickly can move consequences just as fast, sometimes before anyone has time to react. London's money machine is impressive. It is elegant. It is global. But it is not neutral. It rewards those who understand it. It protects those who are closest to it. And it shapes outcomes long before the public ever notices. That's why it still matters today. In a world of instant trading, digital banking, and invisible transfers moving across continents in seconds, what happened in London isn't just history. It's the blueprint of modern finance. And once you see the blueprint, you start noticing the patterns everywhere. The quiet concentration of influence, the hidden decisions inside normal systems, the way capital seems to find its preferred pathways again and again, because money doesn't just move, it is guided. When